What is finance? Finance is defined by Webster's dictionary as the system that includes the circulation of money, the granting of credit, the making of investments, and the provision of banking facilities. Finance has many facets or areas, which makes it difficult to provide one concise definition. But this lecture will give you an idea what finance professionals do and what you might do if you enter the finance field. Finance is generally divided into three areas: financial management, capital markets, and investments. Financial management, or corporate finance, focuses on decisions relating to how much and what types of properties or assets to acquire, how to raise the capital needed to purchase assets, and how to run the firm so as to maximize its value. The same principles apply to both for-profit and not-for-profit organizations. Capital markets relate to the markets where interest rates, along with the stock and bond prices, are determined. Also studied here are the financial institutions that supply capital to businesses. Banks, investment banks, stockbrokers, mutual funds, insurance companies, and the like bring together savers who have money to invest and businesses, individuals, and other entities that need capital for various purposes. Governmental organizations such as the Bangko Sentral ng Pilipinas, which regulates banks and controls the supply of money, and the Securities and Exchange Commission, or SEC, which regulates the trading of stocks and bonds in public markets, are also studied as part of capital markets. Investments relate to decisions concerning stocks and bonds and include a number of activities, such as security analysis, portfolio theory, and market analysis. Security analysis deals with finding the proper values of individual securities, such as stocks and bonds. Portfolio theory deals with the best way to structure portfolios or baskets of stocks and bonds. Rational investors want to hold diversified portfolios in order to limit risks. So, choosing a properly balanced portfolio is an important issue for any investor. A common piece of advice is do not put your eggs in one basket. Market analysis deals with the issue of whether stock and bond markets at any given time are too high or too low, or about right. Included in market analysis is behavioral finance, where investor psychology is examined in an effort to determine whether stock prices have been bid up to unreasonable heights in a speculative bubble or driven down to unreasonable lows in a fit or irrational pessimism. Although we separate these three areas, financial management, capital markets, and investments, they are closely interconnected. Banking is studied under capital markets, but a bank lending officer evaluating a business loan request must understand corporate finance to make a sound decision. Similarly, a corporate treasurer negotiating with the banker must understand banking if the treasurer is to borrow on reasonable terms. Moreover, a security analyst trying to determine a stock's true value must understand corporate finance and capital markets to do his or her job. In addition, financial decisions of all types depend on the level of interest rates. So, all people in corporate finance, investments, and banking must know something about interest rates and the way they are determined. Most businesses and not-for-profit organizations have an organization chart similar to this one. The board of directors is the top governing body, and the chairperson of the board is generally the highest ranking individual. The CEO, or Chief Executive Officer, comes next, but note that the chairperson of the board often also serves as the CEO. Below the CEO comes the Chief Operating Officer, or the COO, who is often also designated as the firm's president. The COO directs the firm's operations, which include marketing, manufacturing, sales, and other operating departments. The Chief Financial Officer, or the CFO, who is generally a senior vice president and a third ranking officer, is in charge of accounting, finance, credit policy, decisions regarding asset acquisitions, and investor relations, which involves communication with stockholders and the press. If the firm is publicly owned, the CEO and CFO must both certify to the SEC that reports released to stockholders, and especially the annual report, are accurate. If inaccuracies later emerge, the CEO and the CFO could be fined or even jailed. This requirement was instituted in 2002 as a part of the Sarbanes-Oxley Act. The act was passed by the U.S. Congress in the wake of a series of corporate scandals involving now defunct companies such as Enron, where investors, workers, and suppliers lost billions of dollars due to false information released by those companies. Enron Corporation was an American energy, commodities, and services company. Before its bankruptcy in late 2001, Enron was one of the world's leading electricity, natural gas, pulp and paper, and communications companies with claimed revenues of nearly $101 billion in 2000. Enron is now chiefly remembered for a massive accounting fraud scandal. The company used special purpose entities, corporate structures designed for specific transactions, to hide its debt and inflate profits. This made the company appear more profitable than it actually was. Which in turn inflated its stock price. When the fraud was revealed, Enron's stock price collapsed, and the company filed for bankruptcy in December 2001.